Hello, I'm Chris Sarley, Investment Research Analyst at Fund Calibre, and today I'm delighted to be joined by David Coombs, Manager of the elite-rated Rathbone Strategic Growth Portfolio. David, thank you for joining us.
Thank you for having me.
I understand the fund had a reasonably high cash position ahead of the crash in late February and early March. Were you expecting the worst, and have you been putting that cash to work to good use since then, really?
We weren't expecting the worst. We obviously we didn't anticipate this crisis. We don't try and forecast crisis. We're not trying to market time. We never look for black swans because you can't find them, right? So, but we did go into the year very cautious, and we had a very strong year in the fund last year. We kind of outperformed our own expectations, to be honest, in terms of what we achieved by being sort of very biased to the US and to growth, in particular within the equity part of the portfolio. So we could see that a lot of the assets in the fund were quite expensive, and we were a bit nervous and felt we wanted to just put the brakes on. So we went into the year with quite elevated cash positions. We had sovereign bond positions in Japan, Singapore, US, and UK, and we had put options on the S&P 500. So that's obviously worked out well for us, but it was there from an overall market perspective rather than looking at a specific one-off event. And then, so during February and March, as you alluded to, that allowed us, and that L bucket I talked about, allowed us to rebalance on a daily, sometimes intraday basis, buying into those falls and maintaining our risk. So we didn't change any of the assets in our portfolio during that period, in the equity portfolio. We just added to our existing names, because our overarching long-term themes haven't changed. We added 3 or 4 companies off the bench that we've been looking at for some time, like Cadence and Ansys, which are both computer-assisted design companies, where their valuations have come back so far in mid-March in particular. So that liquidity gave us the opportunity to keep our equity weighting at 60%, which is where we started the year. We maintained 60 right through March and April every day using that cash that we had. And then towards the end of April, we pushed equities up again to 62, and we bought some other distressed assets. So when you go into a crisis, it's not just what you own, it's what you don't own. We didn't have property, we didn't have credit, we didn't have high yield, we didn't have emerging debt. So we're starting to buy those now. And that's what the liquidity bucket does. It forces that discipline. And when you get into this current situation, it's given us that opportunity to really manage the portfolio effectively.
You mentioned distressed assets there. Have the majority of your additions on the equity side been based on attractive prices, or are there certain stocks that have been on the bench perhaps that you feel prosper due to the changes in consumer behaviour once we get some sort of semblance of a new normal?
No, we think consumer behaviour had already changed prior to this crisis, and all this crisis is doing is accelerating that. The move towards e-commerce and digitalisation, these are not new. They've accelerated. Before we started this podcast, we talked about home working and video conferencing. This is not new technology, and these trends are already happening. I think they will accelerate, maybe not to the extremes that many commentators are suggesting. So our themes haven't really changed. We didn't go out and buy a lot of value stocks or cheap stocks. We're not doing that. We're not buying distressed equities. We're not buying UK banks or retailers or what you might call value stocks. We think that's really about the wrong place to be for a number of years from now. We've added to more tech stocks and healthcare stocks actually during the last 2 or 3 months, where they'd already bid up because, as I said, these trends are not new. So it allowed us to buy some of those tech stocks cheaper, but they were still on P's over 20 times. You wouldn't call them distressed equities. The distressed assets we bought have been emerging debt and high yield, double B rated bonds, the so-called fallen angels. So these are the investment grade bonds like Ford. They've been downgraded now. So the investment grade bond managers have to sell it. The ETFs have to sell it. They're forced sellers of these bonds. They fall into high yield, and we think that that's quite a good opportunity to buy. So we've been very selective in those distressed assets. It's been emerging debt, emerging corporate debt, and double B rated high yield bonds, global bonds, that is, not necessarily UK.
I see you have a gold ETF as the top holding in your portfolio at present. Do you believe the asset class is in a good spot regardless of what happens to the economy?
So I can never be described as a gold bug. I very rarely held gold in my career, to be honest. But right now, it feels, going into this year, it felt the right asset to have. And why is that? Because gold is one of the best hedges to deflation. And one of the interesting debates that's now going on, maybe even arguments, should I say, between economists is, because of all the fiscal easing and monetary easing, are we entering a new inflationary era? We're printing money across the world. Whereas before we came into this crisis, we were in a deflationary era because of e-commerce, digitalization, some of those things I've talked about. And now we've got these two forces coming together, this long-term deflationary globalization, advance of technology, fighting against the printing of money. And who's going to win? Which is going to win? And economists are going to spend hours at dinner parties chatting about this now over the next 12 months and 18 months. My best guess is that deflation will just outweigh the inflation, and the Chinese supply lines will not be cut off as much as people think. So on a core structural medium-term view, I think we're still heading for deflation, and gold is a great hedge for deflation. In the short term, the fear of inflation might rise, and that may impact markets. And so to offset the shorter-term risk, we are buying US index-linked bonds.
I wanted to talk about oil prices a little bit. They've obviously seen significant volatility recently. We've seen extreme lows with the oil price war between the Saudi and Russia, and then we've seen them turn negative due to a market technicality. All this and the impact of the pandemic has put tremendous pressure on the oil price, oil companies, and we've seen the likes of Shell announce it's cutting its dividend for the first time since World War II. By contrast, you've actually added to oil companies, though. Could you perhaps explain why that's the case?
Yeah, we're in a bear market, and if you think you're in a bear market overall, in oil stocks, you're in a deep bear market. And the thing about bear markets is you've got to try and leave the emotion and leave the noise aside. And energy stocks are distressed assets right now, and buying them is difficult. It's uncomfortable. It's gut wrenching. Everyone's telling us the wrong thing to do until Goldman Sachs came out today with a recommendation. But it just feels to be the right thing to do, in the sense that I don't believe there will not be more than one or two more oil cycles in the next 10 to 20 years. We're not going to have zero oil demand in the next 20, 25 years, despite some of the rhetoric. So you've got an oil price pretty much near an all-time low, certainly in my lifetime. Yes, you've had a lot of speculative technical problems at the short end of oil pricing, which has been a factor. And you've got oil companies on very cheap valuations. So it's a structurally challenged area, but it's highly complex. And so when we own Total and BP and Shell, which have this, the best quality balance sheets in the sector, they're well-managed companies. They're still going to generate a lot of cash flow in the next 10 years. And so we think, as part of a multi-asset portfolio, they add a lot in terms of diversification. Because what if, because a lot of current suppliers fall out of the market because they go bust, you could see a supply squeeze in the short term for oil, and the oil price could go up. If the oil price goes up, that's a tax on global growth. And therefore, having those oil companies could be a very good diversifier if we go into a period of higher inflation and lower growth. So it makes sense for me, from a risk perspective, to own those oil stocks. I am not saying they're going to double or triple or quadruple in value over the next 5 years. That's not why I'm buying them. I'm buying them because I think they're very cheap. I think there's a floor to the prices. As you said, Shell have already cut their dividend. BP may well follow, I suspect. Total have maintained theirs this week. But I feel quite comfortable I'm buying an asset that nobody really wants. There's a floor on it. You can't say they're over-owned. They're probably under-owned. And they do provide good diversification to a multi-asset portfolio. Because when the oil price is below the cost of production, the correlation between energy stocks and the oil price is very high. So that, to us, makes sense. And we take the emotion out of it. And as uncomfortable as it has felt, and I can assure you we have discussed it a lot, we have felt it appropriate to add to our positions there. Sorry, long answer to your question.
That's no problem at all, David. Thank you very much for spending some time with us today.
Thank you for having me.
For more information on the Rathbone Strategic Growth Portfolio, please visit fundcalibre.com.